Welcome back to the deep dive. Ever wondered how the companies whose apps you use or whose products sit in your fridge actually get the massive amounts of money they need, to build new factories, innovate, or sometimes just keep the lights on? It's not magic. It's actually a fundamental strategic choice every single business faces. Today, we're embarking on a deep dive into the very core of corporate finance, something called capital structure and the weighted average cost of capital, or WACC as it's often known. Our mission is really to pull back the curtain on how companies finance themselves, understand the true price tag, the cost of that money, and reveal how these critical decisions ripple through a company's very value, its potential for growth, and even how risky it is perceived to be.
And trust me, this isn't just theoretical finance jargon floating out there. Whether you're looking at a garage startup or a sprawling global conglomerate, understanding these concepts is like getting your hands on their financial blueprint. It really is. We're going to break down what might seem like complex formulas and ideas into, hopefully, crystal clear insights, helping you truly grasp how businesses tick.
Excellent. So let's kick off with the foundational concept then. Capital structure. When a company needs cash, its first big choice is often, do we borrow it or do we sell off a piece of the company? Capital structure is essentially the specific blend, that mix of those two main ways a company funds itself, that's debt and equity. It's like the financial DNA of a business, dictating its fundamental approach to funding operations and growth.
Precisely. You can really think of it as a company's financial recipe. How much of that recipe relies on borrowed money versus how much comes from actual ownership stakes. That balance, that precise mix of ingredients is what we're talking about when we refer to capital structure, and it's a critical strategic decision, make no mistake.
Okay, let's dive into the borrowed money side first. Debt financing. This is often seen as maybe the more straightforward route, but it's rarely as simple as just taking out a single loan, is it? Companies use a whole array of debt, ranging from short-term fixes to really long-term commitments. Why do they need both types?
Well, that's a great question. Short-term debt is usually for the immediate, flexible needs. Think of it as a financial sprinkler system for daily operations or funding current assets. For example, you have basic short-term notes payable, which are essentially just straightforward loans due in less than a year. Pretty simple. Then there's commercial paper, which is quite fascinating, actually. This is an unsecured corporate debt, meaning there's no specific asset backing it up. And it typically matures in 270 days or less. Companies often use it for very quick, sometimes large infusions of cash, like financing inventory during a peak season or maybe covering other immediate obligations. It's known for being fast and flexible, especially for companies with really good credit ratings.
So unsecured means more risk for the lender,
Right.
right? But faster for the company.
Exactly. And then, of course, you have line of credit arrangements. These are sort of like a corporate credit card, a pre-approved limit you can draw upon as needed. They offer immense flexibility for managing cash flow day to day.
Okay, that covers the short-term fixes.
Yeah,
What about the bigger, longer-term stuff? Funding major investments.
right. Moving to the long-term side, where companies fund things like new facilities or maybe acquisitions, we find structures like traditional long-term notes payable. But then there are debentures. These are also unsecured corporate debt, just like commercial paper. But crucially, they have a much longer maturity. And again, when we say unsecured, it means that if the company unfortunately goes bankrupt, there's no specific asset set aside for debenture holders to claim. They're general creditors, which means they basically stand in line with other unsecured claimants. It's quite different from, say, a mortgage bond where you have specific collateral.
So for the lender, no direct collateral on a debenture definitely means more risk.
Okay.
How do companies make that appealing enough for someone to lend them money that way?
That's exactly why we have things like subordinated debentures. Now, this is where it really gets interesting in terms of the risk-return trade-off. Subordination means these particular debentures rank behind senior or higher priority creditors if the company goes into liquidation. Imagine you're at a buffet, right? The senior creditors get to fill their plates first. Only if there's food left over do the subordinated debenture holders get anything.
Ouch. So they're last in line.
Pretty much. Because they're at the very back of the line, they naturally carry higher interest rates. This compensates investors for taking on that significantly increased risk.
Makes sense. A bigger potential reward for taking a much riskier seat at the table. Are there other unique debt structures companies use?
Oh, absolutely. There are income bonds, which are quite unique because their interest payments are actually contingent on the company achieving certain target income levels.
Mm.
For the company, this can be a lifesaver, right?
Mhm.
It reduces fixed obligations during lean times. But for the bondholder, well, it means their interest payments aren't guaranteed. That adds a layer of uncertainty to their return.
So the payout depends on performance. Interesting.
And then, on the far end of the risk spectrum, you have junk bonds. The name pretty much tells you the story. They're non-investment grade bonds, characterized by a very high default risk. But, and this is the key, because of that high risk, they also promise very high potential returns. Why would an investor take on such risk? They're hoping for that significantly higher payout if the company performs well.
And the company issuing them.
For the company, issuing junk bonds might be their only option sometimes for raising significant capital, perhaps if they're a high-growth startup or maybe a company undergoing a major restructuring.
Okay, so a junk bond is like a high-stakes gamble for both sides, really. What if a company wants to borrow money but offer more security to the lender, something less risky?
That's precisely where mortgage bonds come into play. These are secured by real property. Think of them as bonds backed by specific assets like buildings, land, or even pools of mortgages. What this means is, if the company defaults, the bondholders are protected because they have specific liens on these real property assets. Trustees who manage these bonds can then foreclose on those mortgage assets to repay the bondholders. It offers a much more secure position for the lender.
Which generally means a lower interest rate for the company borrowing the money, I assume.
Generally, yes. Lower risk for the lender often translates to a lower cost for the borrower. And finally, let's touch on leases, specifically what are called finance leases. Now, this goes far beyond just renting some office space. A finance lease is a contractual agreement where the owner, the lessor, allows another party, the lessee, to use an asset for periodic payments over a substantial portion of the asset's life. The key here, the really important part, is how these impact the company's financial statements. With a finance lease, the lessee effectively treats the asset almost as if they own it. They record a right-of-use asset and a corresponding lease liability right there on their balance sheet.
Ah, so it shows up directly on the balance sheet, unlike a simple rental payment.
Exactly. And on the income statement, you'll see both interest expense on that lease liability and amortization expense on the right-of-use asset. This is a big departure from what's called an operating lease, where you typically just see a simple lease expense on the income statement, and crucially, no asset or liability showing up on the balance sheet. It's a very different financial footprint, signaling a much more significant long-term commitment.
Wow, that's a really comprehensive look at the debt side, all the different flavors. Now let's pivot to the other side of the coin, equity financing. This is where a company issues stock, essentially selling ownership stakes. And a crucial differentiator here, you mentioned it briefly, is that in a bankruptcy or liquidation, shareholders have the lowest claim. They are behind all debt holders, whether secured or unsecured, really at the very bottom of the priority list.
And what's fascinating about that lowest claim is what it implies. It means equity holders inherently take on the most risk. They are absolutely the last in line if things go south. But, and this is the flip side, it's also where the biggest potential for reward lies. If the company absolutely takes off, their ownership stake can multiply in value far, far beyond any fixed interest payment a debt holder would ever receive. It truly embodies the ultimate risk-reward trade-off in finance.
So let's break down equity. There are two main types, right?
That's right. Let's start with preferred stock. Preferred stock is often called a hybrid security, and for good reason. It truly blends features of both debt and common equity. Like debt, it usually has a fixed dividend payment promised to its holders, very similar to a bond's coupon payments, a set amount or percentage. However, here's the equity-like part. The decision to actually pay that dividend is entirely at the discretion of the company's board of directors. It's not a mandatory obligation like interest on debt.
Ah, so unlike debt interest, which must be paid to avoid default.
Correct. Missing a preferred dividend payment doesn't typically trigger default. And critically, unlike interest payments on debt, preferred stock dividends are not tax-deductible for the corporation. That's a huge difference. So the fixed payment feels a bit like debt, but its discretionary nature and the tax treatment align it more with equity.
So it's like getting a fixed promise, but it comes with a big subject to board approval asterisk. That's a crucial distinction for investors to understand.
Absolutely. Then we move to common stock. This represents the most fundamental ownership of a corporation. True ownership. The key feature that distinguishes common stock from preferred is that common shareholders typically have voting rights. This gives them a direct say, at least theoretically, in how the company is run, including electing the board of directors.
And dividends for common stock.
Even more optional than preferred. Entirely dependent on the board's decision, the company's performance, its cash flow situation, future investment plans, lots of factors. Now, when common stock is issued, it often comes with a stated par value. This is usually a very small, almost nominal amount per share, like a penny or even less sometimes. For accounting purposes, the proceeds the company receives from selling the stock are split. The par value times the number of shares issued goes into the common stock account on the balance sheet. And any amount received above that par value is allocated to what's called the Additional Paid-In Capital APOC account, sometimes called capital surplus.
So that split is mainly an accounting thing.
Primarily for accounting and legal purposes, yeah. It reflects the minimum legal capital required for the shares in many jurisdictions. And as we've reiterated, the biggest downside for common shareholders is being at the very bottom of the payout totem pole in a liquidation scenario. Last in line.
Okay. To quickly summarize the fundamental differences between debt and equity financing, maybe we can run through a few key characteristics side by side, almost like a quick comparison chart or a pass key for understanding their strategic implications.
That's an excellent way to consolidate the core distinctions. Let's do it. First, flexibility. Debt offers no real flexibility because those interest payments are legally mandatory. Rain or shine for the business, they have to be paid. Equity, on the other hand, provides, yes, flexibility because dividend payments are optional. The board can adjust them or even suspend them.
Okay, flexibility goes to equity. What about taxes?
Tax deductibility. This is a huge advantage for debt. Interest payments are tax deductible for the company. This effectively reduces the true cost of borrowing. Equity dividends are not tax deductible. Big difference.
Advantage. Debt. What about impacting existing shareholders?
EPS dilution, earnings per share dilution. Issuing new shares of common equity can lead to, yes, dilution, meaning existing shareholders' earnings per share get spread thinner across more shares outstanding. Debt issuance generally leads to no dilution of EPS for existing shareholders.
So issuing stock can water down existing ownership value per share. Risk.
Increased financial risk. Debt carries, yes, higher financial risk. That's due to those fixed mandatory payments. Miss them, and you could face default or bankruptcy. Equity has no inherent increase in fixed financial risk from its own issuance. The risk is more about market value fluctuation.
Right, and the cost to actually issue these securities.
Security issuance costs. It's generally low to issue debt. It's often a more straightforward process, maybe dealing directly with banks or a smaller group of investors. Equity issuance costs are typically high, often involves investment bankers, roadshows, extensive regulatory filings. It's more complex and costly.
Okay, costs favor debt issuance. Finally, what about the return investors expect?
Investor return. Debt offers a largely fixed return profile through those predictable interest payments and return of principal. Equity offers a variable return. There's potential for significant capital appreciation if the company does well, but also the risk of significant loss. It's certainty versus potential upside.
That's a fantastic summary. So, we've broken down the components of capital structure, the ingredients in that financial recipe. But now, the really big question, what is the actual cost of those ingredients? How much does it really cost a company to use that specific blend of borrowed money and ownership stakes? That brings us squarely to the heart of the matter. The weighted average cost of capital, or WACC.
Absolutely. WACC is such a critical concept because it directly links a company's long-term investment decisions, like building a new factory or launching a new product, to the wealth of its owners, the shareholders. In essence, the WACC is simply the average cost of all forms of financing a company uses, but it's weighted by their proportion in the company's total capital structure.
Weighted meaning, if you use more debt, the cost of debt counts more in the average.
Exactly. Reflects the actual mix. Think of it as the minimum rate of return a company must expect to earn on any new project or investment just to break even in terms of value. If it earns less than its WACC, it's actually destroying shareholder value. It's often referred to internally as a hurdle rate. If a potential project doesn't promise to clear that WACC hurdle, it's typically not worth pursuing from a purely financial standpoint.
And why is minimizing this WACC so important?
Well, here's the crucial link. The value of a firm can fundamentally be thought of as the present value of all the future cash flows it's expected to generate, and the rate you use to discount those future cash flows back to today's value. That's the WACC. Therefore, the theoretical optimal capital structure, that perfect blend of debt and equity, is the specific mix that produces the lowest possible WACC. Finding and maintaining that lowest WACC is, you could say, the holy grail for finance managers because it directly maximizes the value of the firm for its shareholders. Lower discount rate equals higher present value.
That's a powerful goal, maximizing firm value by minimizing cost. So how do we actually calculate this WACC? It sounds potentially complex, but you said at its core, it's just a weighted average. Can you walk us through the idea behind the formula?
You got it. While the full formula might look a bit intimidating at first glance with all its letters and symbols, the underlying concept is actually pretty simple. You're taking the cost of each type of money the company uses, whether that's equity from common shareholders, preferred stock, RP,
Right.
or debt, RD, and then you multiply the cost of each by how much of that type of money the company actually uses in its structure, its weight. Then you just add all those weighted costs together. And for debt, remember, we get that special bonus to the tax break. So we factor that in.
Okay, so what does the formula look like?
The formula is WACC equals EVRE plus PVRP plus DVRD one time. Let's break that down. E, P, and D represent the market values of common stock equity, preferred stock equity, and debt, respectively. We use market values because they reflect the current real-world cost of financing.
Not the book values from the balance sheet.
Generally, market values are preferred because they reflect today's investor expectations and costs. V is just the total market value of the firm, E plus P plus D. So EV, PV, DV are just the weights or percentages of each component. RP, and RT are the required rates of return, or simply the cost, for each component what investors demand for providing that capital. And finally, T is the corporate tax rate. That one T factor is applied only to the cost of debt, RD, to reflect the tax deductibility of interest payments.
Right, the tax shield only applies to debt. Let's put this into practice with a quick example to make it concrete. Imagine a company, let's call it Apex Core. Let's say their finance team has estimated the cost of common stock is 8.4%, the cost of preferred stock, RP, is 6.8%, and their weighted average interest rate on debt, RT, is 6.0% before taxes. And their capital structure, based on current market values, is 55% common stock, EV, 20% preferred stock, PV, and 25% debt, DV. The corporate tax rate, T, is 30%. What's Apex Core's WACC?
Okay, great example. First things first. Let's account for that tax break on debt. The 6.0% interest rate isn't the true cost to Apex because the interest is deductible. So we calculate the after-tax cost of debt. RD 1 to T equals 6.0%, 1.30, 0.70 equals 4.2%. That's the effective cost of debt after considering tax savings.
Got it. 4.2% is the number we use for debt in the WACC formula.
Exactly. Now, we just plug everything into the WACC formula. WACC, weight of equity, cost of equity, plus weight of preferred, cost of preferred, plus weight of debt after tax, cost of debt. WACC is 0.55, 8.4%, plus weight of preferred, cost of preferred, plus weight of debt after tax, cost of debt. WCC is 0.0162, plus 0.2 yields 0.0102 is 0.0136, plus 0.010136, plus Apex score 0.0703. So Apex score's WACC comes out to 7.03%.
So that 7.03% is their magic number, their hurdle rate. If Apex is considering a new project, let's say building a new warehouse, that project needs to promise a return of at least 7.03% just to cover the cost of the capital they're using to fund it. Anything less than 7.03% would actually be a bad investment, essentially destroying shareholder value over time.
Precisely. That's the benchmark. And just to clarify a point on the individual capital components included in WACC, it typically focuses on the long-term permanent financing mix of the firm. So that definitely includes long-term debt, preferred stock, common stock, and also retained earnings, which represent equity capital reinvested in the business.
What about short-term stuff?
Short-term elements are usually only included if they are interest-bearing and part of the ongoing financing strategy, like certain notes payable. Importantly, other forms of current liabilities like accounts payable, money owed to suppliers, and various accruals like wages payable are generally not included in the cost of capital calculation.
Why not? They're liabilities.
Because they typically represent interest-free capital that arises naturally from the course of operations. They're not explicit financing decisions in the same way as issuing bonds or stock. And always remember, when we evaluate the cost of these components, especially debt, we're focused on the after-tax cash flows. That tax deductibility of interest is just so crucial. It creates that powerful tax shield that lowers the effective cost.
Okay, let's zoom in a bit more on the weighted average cost of debt. You've emphasized the tax shield, but it's clearly more than just the coupon rate on a bond. Can you elaborate on why calculating this cost accurately is so critical?
It's vital because debt is often a significant part of the capital structure, and getting its cost wrong throws off the entire WACC calculation. The relevant cost we care about for long-term debt is always the after-tax cost of raising those funds through borrowing. These sources, as we mentioned, usually include issuing bonds or taking out long-term loans. Debt costs are generally stated as an interest rate. Sometimes you'll hear it expressed in basis points above a benchmark rate. like U.S. Treasury bonds.
Basis points, that's just jargon for.
Oh, right. A basis point is simply 1/100th of 1%, 0.01%. So 100 basis points is 1%. It's just a common way financial folks talk about small changes in interest rates. We distinguish between the pre-tax cost of debt, which is simply the yield or interest rate before considering any tax effects, and the after-tax cost of debt. Because interest on debt is tax deductible, those tax savings effectively reduce the company's true net cost of that debt. Imagine getting a discount every time you pay interest. That's essentially what the tax shield provides. The formula, as we used it before, is straightforward. After-tax cost of debt equals the pre-tax cost of debt multiplied by 1 minus the corporate tax rate.
Okay, so let's run another quick debt example. If a firm has a pre-tax cost of debt, maybe the current yield on its long-term bonds of 12.5% and its effective corporate tax rate is 30%, what's their actual after-tax cost of that long-term debt?
Right, so the pre-tax cost is 12.5%. The tax rate is 30%. This means the company essentially gets a 30% discount on that interest expense due to tax savings. You take the 12.5%, or 0.125, and multiply it by 1 minus 0.30, which is 0.70. So 0.125 equals 0.0875. That brings the after-tax cost of debt down to 8.75%.
That's a significant reduction from 12.5%.
It really is, and this highlights a crucial past key insight from our sources. Debt consistently carries the lowest cost of capital among the major financing sources, primarily because its interest is tax deductible. It also leads to another key strategic point. The higher the corporate tax rate, the more incentive a company has to use debt financing, because those tax savings become even more valuable. It's a powerful incentive baked into the tax code that shapes many capital structure decisions globally.
That tax shield certainly provides a clear, quantifiable advantage for using debt. Okay, next up, let's talk about the cost of preferred stock. How does its cost calculation differ from debt, especially concerning that tax treatment we just discussed?
The cost of preferred stock is, in principle, simpler. It's basically the rate of return investors require on preferred shares, which is primarily driven by the dividends paid. Unlike debt interest, after-tax considerations are completely irrelevant here. Why? Because preferred stock dividends are paid out of the company's after-tax profits, and they are not tax-deductible for the company paying them. So, no tax shield benefit for preferred stock.
So the cost is just the dividend payment relative to the funds received.
Pretty much. The formula is straightforward. The cost of preferred stock equals the annual preferred stock dividend per share divided by the net proceeds per share of preferred stock. Preferred stock dividends can be stated as a fixed dollar amount per share, or more commonly, as a percentage of the stock's par value. For example, 10% preferred stock with a $100 par value typically means it pays an annual dividend of $10 per share, 10% of $100, assuming the board declares it. And net proceeds simply refers to the price the company actually received from issuing the preferred stock after deducting any flotation costs.
Flotation costs.
Yeah, those are the costs associated with issuing new securities, things like investment banking fees, legal fees, registration costs. They reduce the amount of cash the company actually gets to keep.
Makes sense. Let's quickly calculate an example then. Suppose a firm issues 10%, $100 par value preferred stock. It's issued right at its par value of $100, but there were flotation costs of $5 per share. What's the actual cost of this preferred stock to the company?
Okay, so the annual dividend is 10% of the $100 par value, which is $10 per share. The company issued it at $100, but had to pay $5 in flotation costs, so the net proceeds they actually received per share were $100. $5 is approximately $95. Now we use the formula, cost, annual dividend net proceeds. So cost $10, $95. Calculating that, $10 divided by $95 is approximately 0.1053, or 10.53%.
Interesting. So even though it's 10% preferred stock, the actual cost to the company is slightly higher, 10.53%, because of those issuance costs.
Exactly. Those flotation costs matter, especially for equity, which tends to have higher issuance costs than debt.
All right, now for the component that often seems to trip people up, the cost of retained earnings. This is money the company already has, right? It's the profits they didn't pay out as dividends. So why does it have a cost? Isn't it just free money sitting there?
That's a great question, and it gets right to the heart of a fundamental economic principle, opportunity cost. It's definitely not free money. Retained earnings, fundamentally, belong to the common stockholders. Think of it this way. When a company decides to keep those earnings and reinvest them back into the business instead of paying them out as dividends, it's essentially making an investment decision on behalf of its shareholders. It must, therefore, earn at least the rate of return that those same shareholders could have earned if they had received those earnings as dividends and then invested that money themselves in alternative investments of equivalent risk.
Ah, so the cost is the return shareholders are giving up by letting the company keep the money.
Precisely. It's the opportunity cost of not distributing those earnings. Shareholders expect the company to generate a return on those reinvested earnings that's at least as good as what they could get elsewhere for similar risk. And just like preferred stock dividends, the cost of retained earnings is an equity concept. So after-tax considerations are irrelevant here. Dividends, whether paid out or retained and reinvested, come from after-tax income and are not tax-deductible for the company.
Okay, that makes sense conceptually, but how do you actually measure that opportunity cost? It sounds a bit subjective.
It can be more subjective than calculating the cost of debt or preferred stock, absolutely.
Hmm.
Given the subjectivity, finance professionals typically rely on three common and well-accepted methods for estimating the cost of retained earnings. These are the capital asset pricing model, often called CAPM, the discounted cash flow, or DCF model, and the bond yield plus risk premium, or BYRP method.
Okay, three different approaches. Let's start with the capital asset pricing model, or CAPM. This is a really widely used model in finance, isn't it, for assessing risk and expected return?
It truly is a cornerstone model, yes. The core idea behind CAPM is that the cost of retained earnings, which is essentially the required return on common equity, is equal to a risk-free rate plus a risk premium. The risk-free rate represents the return you could earn on a totally safe investment, usually proxied by the yield on long-term government bonds, like U.S. Treasuries. The risk premium is the extra return investors demand for taking on the additional risk of investing in a specific stock compared to the risk-free asset. CAPM breaks this premium down further.
How does it do that?
It says the risk premium for a specific stock depends on two things. First, the overall market risk premium, that's the extra return the entire stock market is expected to provide over the risk-free rate. And second, the stock's specific sensitivity to that market risk, which we measure using something called the beta coefficient.
Beta. I've heard that term. What exactly is it?
Beta is a numerical measure of a stock's volatility, or you could say it's systematic risk relative to the overall market. Think of the market as having a beta of 1.0. If a stock has a beta greater than 1, say 1.5, it means it tends to be 50% more volatile than the market. It goes up more when the market goes up and down more when the market goes down. Higher risk. If a stock has a beta less than 1, say 0.8, it's less volatile than the market, lower risk.
Okay, so beta measures relative riskiness. How does that fit into the CPM formula?
The risk premium for a specific stock in the CAPM model is calculated as that stock's beta multiplied by the market risk premium, which is the market return minus the risk-free rate. So the full formula for the cost of retained earnings using CAPM is cost of retained earnings, risk-free rate, plus beta X market return, risk-free rate.
All right, let's run the numbers. Suppose a firm's stock has a beta of 1.25. The current risk-free rate is 8.75%, and the expected return on the overall market is 14.25%. What would CAPM estimate as the cost of retained earnings for this firm?
Okay, let's plug those in. We start with the risk-free rate of 8.75%. Then we calculate the market risk premium. Market return, 14.25%, minus risk-free rate, 8.75% and 5.50%. Now we multiply that market risk premium, 5.5%, by the firm's beta, 1.25. 1.25, 5.50%. This is the specific risk premium for this stock. Finally, we add the risk-free rate to this stock-specific risk premium. 8.75% plus 6.875% equals 15.625%. So according to CPM, the estimated cost of retained earnings for this firm is 15.63%. This is the minimum annual return shareholders expect the company to generate from reinvesting earnings given the perceived risk.
That's clear. Now, the second method you mentioned for estimating the cost of retained earnings is the discounted cash flow, or DCF method. What are its core ideas and assumptions? How does it work?
The DCF approach looks at the value of a stock as the present value of its expected future dividends. It rests on a few key assumptions. First, it generally assumes that stocks are fairly priced in the market, meaning their current price reflects the present value of future cash flows, so that the expected return should equal the required return. Second, it relies heavily on estimating the expected future growth rate of the company's dividends per share. This growth rate can be estimated in several ways. Looking at the company's historical dividend growth, using a retention growth model, which links growth to how much earnings are retained and the return earned on those retained earnings, or sometimes using forecasts from market analysts.
And the formula itself.
The most common form of the DCF formula for the cost of retained earnings, or cost of equity, key, is K equals D1 P0 plus G Let's break that down. D1 is the dividend per share expected to be paid at the end of 1 year. P0 is the current market price per share of the common stock. And G is the expected constant rate of growth in dividends going forward.
So the expected dividend yield plus the growth rate.
Exactly. It represents the total return shareholders expect, part from the cash dividend yield, D1P0, and part from the capital appreciation driven by the expected growth in future dividends.
Gee. Let's work through an example with the DCF method then. Suppose we have a company that operates as a constant growth firm. It just paid its annual common stock dividend, D0, which was $2 per share. The company expects its dividends to grow at a constant rate G of 7.5% per year indefinitely, and the current market price for its common stock, P0, is $25.25 per share. What's the cost of retained earnings using DCF?
Okay, first we need to calculate the expected dividend for next year, D1. Since the last dividend D2 was $2 and it's expected to grow at 7.5%, D1 will be D01 plus G. So D1 equals $2, 1 plus 7.075 equals $2, 1.075 equals $2.15.
Right, that's the dividend expected in 1 year.
Now we plug D1, P0, and G into our DCF formula. Key equals D1, P0 plus G. Key equals to $2.15, $25.25 plus 0.075. First, calculate the dividend yield term. $2.15, $25.25 is approximately 0.0851 or 8.51%. Then add the growth rate. Key equals 0.0851 plus 0.075 using the DCF method is 16.01%. This reflects the total return shareholders anticipate from both the dividend yield and the expected capital gains driven by that 7.5% growth.
Okay, that's the second method. Our third method for estimating the cost of retained earnings was the bond yield plus risk premium, or BYRP method. How does this approach connect to a company's own debt, its bonds?
The BYRP method makes a sort of intuitive leap. It basically assumes that the underlying risks affecting a firm's equity and its debt are somewhat related, especially when you look at them before considering taxes. Both are influenced by the firm's operating environment and the overall economy. It posits that because equity is inherently riskier than the company's own debt, remember equity holders are last in line, equity investors must require a certain risk premium above the yield that the company's own long-term debt offers.
So you start with the company's debt cost and add something extra for equity risk.
Exactly. This equity risk premium can be estimated, perhaps crudely, based on historical differences, market analyst surveys, or sometimes by subtracting the yield on an average corporate bond from an estimate of the overall expected return on the equity market. The formula for the cost of retained earnings using BYRP was quite straightforward. Cost of retained earnings equal pre-tax costs of the company's own long-term debt plus market risk premium, specific to equity.
Let's try a quick example for the BYRP method. If a firm has estimated its relevant market risk premium for equity at 4.5%, and it knows that the current pre-tax yield to maturity on its own long-term bonds is 11.34%, what's the estimated cost of retained earnings using BYRP?
It's a simple addition here. You just add the firm's own pre-tax bond yield, 11.34%, to the estimated market risk premium for its equity, 4.5%. So 11.34% plus 4.5% equals 15.84%. This method gives us an estimated cost of retained earnings of 15.84%. It provides a relatively quick way to gauge the cost of equity by building directly upon the firm's known cost of debt, which is often easier to observe in the market.
Okay, so we have three different methods. CAPM, 15.63% in our example, DCF, 16.01%, and BYRP, 15.84%. They're all considered valid ways of calculating the cost of retained earnings, but they give us slightly different answers. This raises an important practical question. How do companies choose which method to rely on? And what do they do if the results from these different methods are inconsistent, like they are here, albeit reasonably close?
That's a very practical challenge, you're right. Companies and financial analysts, too, often calculate the cost of equity using all three of these methods, precisely because each one relies on slightly different assumptions and inputs, some of which might be more reliable or easier to estimate than others. If the results from the three methods show what might be called sufficient consistency, meaning they are reasonably close to each other, like in our examples which are all clustered around 16%, then a company might feel more confident. In such cases, they might even decide to take an average of the three resulting cost estimates as their final single estimate for the cost of retained earnings to use in their WACC calculation.
An average seems like a reasonable approach if they're close.
It can be, yes. It offers a potentially more robust estimate than relying solely on one method, which might have specific flaws or data issues in that particular situation. The ultimate choice often depends on factors like the availability and perceived reliability of the input data required for each method, like finding a good beta for CAPM or estimating a stable growth rate for DCF. It also depends on which assumptions the company's finance team feels most comfortable making for their specific business and industry context. There's often an element of judgment involved.
That makes sense. It's about using multiple tools and applying professional judgment. Okay, we've broken down the individual components of capital structure debt, preferred, common equity via retained earnings, and delved into the intricacies of WACC and how the costs of these individual components are calculated. Now let's bring it all back to the why. Why go through all these calculations? You mentioned earlier the ultimate goal, the holy grail for finance managers, is achieving the optimal capital structure. Let's revisit that.
Precisely. Let's tie it all together. The optimal capital structure is that specific target ratio of debt to equity, and sometimes preferred stock, that results in the lowest possible weighted average cost of capital, WACC, for the firm. It's a really delicate balancing act, a truly dynamic interplay between cost and risk. As a company starts taking on more debt initially, the WACC tends to fall. Why?
Because debt is generally cheaper than equity, and you get that tax shield benefit, right?
Exactly. Those two factors make adding some debt attractive. But as leverage continues to increase, taking on more and more debt, eventually both debt holders, the lenders, and equity holders, the owners, start to demand higher returns to compensate them for the increased risk. Lenders worry more about getting paid back, so they charge higher interest rates. Equity holders see their potential future earnings becoming more volatile and the risk of bankruptcy rising, so they demand a higher return on their investment too.
So there's a trade-off. The benefits of debt eventually get outweighed by the costs of higher risk.
Precisely. There's a sweet spot, a point where the benefits of using cheaper tax-deductible debt are perfectly balanced against the rising costs associated with higher financial risk for both forms of capital providers. If a company goes too far, takes on too much debt, the WACC starts climbing back up again, and that actually destroys firm value.
To really help visualize this, I know our sources often describe a conceptual graph. Can you paint a picture of that for us? Imagine the horizontal axis represents the debt-to-equity ratio, how much debt a company has relative to its equity starting from zero debt and increasing. And the vertical axis represents the cost of capital in percentage terms. What would we see?
Okay, great visual. You typically observe three distinct lines or curves on this graph. First, the cost of equity line. It starts at a certain level, representing the cost for an all-equity firm, and begins to curve upwards, often more steeply as the debt-to-equity ratio gets higher. This reflects common shareholders demanding higher returns to compensate them for taking on the increased financial risk that comes with more leverage. Second, the after-tax cost of debt line. This also tends to slope upwards as leverage increases, but usually more gradually at first. Lenders start demanding higher interest rates as the company becomes riskier, but the tax shield still helps keep the after-tax cost down initially. Eventually, though, as bankruptcy risk becomes significant, this cost can rise sharply too.
Okay, cost of equity rises, cost of debt rises after tax. What about the overall WACC?
Now, the most crucial line on this graph is the WACC line itself. It typically forms a distinct U shape, or maybe like a shallow saucer shape. It initially dips downwards as a company incorporates some debt into its capital structure. As we said, this is primarily because debt is generally cheaper than equity, and crucially, its interest payments are tax-deductible, providing that valuable tax shield which lowers the overall average cost of capital. However, beyond a certain point, that optimal point, the bottom of the U as financial leverage becomes too pronounced, the perceived risk for both debt holders and equity holders starts to skyrocket. Lenders demand significantly higher interest rates to compensate for the much higher default risk. Equity holders demand a much higher return for bearing that magnified financial risk and the potential for huge losses and distress. This causes both the cost of debt and the cost of equity to rise more rapidly, which then inevitably pulls the overall WACC, the weighted average, back up, forming the right side of that characteristic U shape.
And the lowest point of that U is the goal.
Exactly. That lowest point represents the optimal capital structure. Our sources even mention a hypothetical example where a firm achieves its lowest WACC when its debt-to-equity ratio hits 4.0. That means for every $1 of equity, the firm has $4 of debt. That particular mix for that specific hypothetical firm represents the financial Goldilocks zone. Not too little debt, not too much debt, where the company's overall value is maximized because its cost of capital is minimized.
So once a company ideally identifies and perhaps targets this optimal capital structure that yields the lowest WACC, how is this WACC actually applied in real-world investment decisions, like capital budgeting?
That's the practical application. Generally, when a company evaluates new investment opportunities, like building that new warehouse we mentioned, or launching a major R&D project, they aim to fund these projects using sources of capital, a mix of debt and equity, that will help them maintain their target optimal capital structure over the long run. And crucially, those new projects must promise an expected rate of return that meets or exceeds the hurdle rate implied by the company's WACC. If the project's expected return is higher than the WACC, it's expected to add value. If it's lower, it's expected to destroy value.
But is the company's overall WACC always the right discount rate to use for every single project?
That's an important caveat. The company's overall historical WACC may not always be the most appropriate discount rate to use for every single new capital project. Why? Because a specific project might carry a significantly different risk profile compared to the company's existing average operations. Maybe it's in a new, riskier market, or uses unproven technology. Or the project might be financed in a way that significantly alters the company's leverage characteristics, perhaps if it's set up as a separate subsidiary with its own debt. In those cases, a more sophisticated approach is needed. The focus should really be on the marginal cost of the new capital being raised specifically to fund that particular project, and potentially adjusting the discount rate to reflect the project's specific risk, rather than just blindly using the company's overall historical average WACC.
Right, so the WACC is a baseline, but you need to consider project-specific risk and financing. Okay, we've spent a lot of time on how a company gets its money, its capital structure, the liability and equity side of the balance sheet. But it's one thing to get the money, and quite another to know what the company does with it. So, what does all this mean when we consider how capital structure relates to the assets a company holds, the other side of the balance sheet?
Excellent point. This brings us neatly to the concept of asset structure. While capital structure focuses on the right side of the balance sheet where the money comes from, debt and equity, asset structure describes the composition of what the company owns on the left side. Specifically, it looks at the dollar amounts and, more importantly, the relative proportions of a company's assets that are classified as current versus non-current or long-term.
Can you give us a quick refresher on current versus non-current assets?
Sure. Current assets are those assets that are expected to be converted into cash, sold, or consumed within the company's normal operating cycle, which is typically 1 year. Think of highly liquid items like cash itself, cash equivalents like short-term money market funds, inventory that's expected to be sold soon, accounts receivable, money owed to the company by its customers, short-term notes receivable, prepaid expenses like insurance paid in advance, and marketable securities classified as trading assets.
Okay, stuff that turns over quickly. And non-current.
Non-current assets, sometimes called long-term assets, represent probable economic benefits that are expected to extend beyond that 1 year period or operating cycle. Examples here include things like long-term investments in other companies, the core operating assets often called property, plant, and equipment, or PP&E. This includes factories, buildings, land, machinery, equipment. Also, intangible assets, which lack physical substance but have value, like patents, copyrights, trademarks, brand names, or goodwill acquired in an acquisition. And sometimes things like deferred tax assets.
So it sounds like there must be a pretty close, maybe symbiotic relationship between how a company finances itself, capital structure, and what it invests in, asset structure. How do they actually influence each other?
They absolutely do influence each other, and it's a constant interplay, a two-way street. For instance, when a company raises significant amounts of long-term capital through new debt or equity issuances, that money is often specifically earmarked to fund large, long-term, non-current assets. Things like constructing new buildings, acquiring another company entirely, or investing in major strategic pieces of machinery or technology.
So capital structure choices fund asset structure choices.
Right. And conversely, when a company issues new debt or equity, regardless of the long-term purpose, it receives an immediate cash infusion. This directly boosts its current assets, specifically its cash balance, at least temporarily. The existing capital structure also influences the types and levels of assets the company needs to hold. If a company has taken on a lot of debt, high leverage in its capital structure, it needs to be very careful to ensure it maintains a sufficient level of current assets, particularly cash and receivables, to ensure it can consistently meet its upcoming interest and principal payments on that debt.
So high debt requires strong liquidity management on the asset side.
Definitely. Similarly, if a company's capital structure includes a lot of equity, and it has a history or policy of paying regular dividends to its common or preferred shareholders, it needs to make sure it generates and holds enough cash, a current asset, to make those optional dividend payments that its shareholders likely expect. So, you see, the choices made on the right side of the balance sheet, how you get the money, dictate what you can realistically put on the left side, what you invest in. And the needs and characteristics of the assets on the left side definitely influence the optimal financing choices on the right.
That interaction is clear. Now, when lenders provide debt financing, they're taking on risk. How do they protect their investments once they've handed over the cash? This brings us to something called loan covenants. These sound like a set of rules or restrictions.
They are indeed a set of rules, or, more precisely, they are specific contractual agreements included in loan documents that lenders use to protect their financial interests. They essentially limit, or sometimes even prohibit, certain actions by the borrower, the company, that the lender feels might negatively affect the company's ability to repay the loan, or actions that might harm the lender's financial position if things go wrong.
And how does the company's capital structure influence these covenants? It seems like the debt equity mix would directly impact how many strings are attached to a loan.
It has a very direct impact. It all comes down to the lender's perception of risk, which is heavily influenced by the borrower's existing capital structure. Think about it. If a potential borrower's capital structure is heavily weighted toward equity, meaning they have low financial leverage, not much debt relative to their equity base, their fixed obligations associated with existing debt are relatively minimal. This provides a large cushion, a margin of safety, for new lenders. In such situations, the loan covenants imposed might not be particularly stringent or difficult for the company to comply with, because the lender perceives less risk that the borrower will struggle to make its interest and principal payments.
Okay, low leverage means easier terms, fewer rules. What about high leverage?
Exactly the opposite. When a borrower already has a significant amount of outstanding debt relative to its equity base, meaning its financial leverage is high, any new lender is coming into a riskier situation. In this scenario, the loan covenants associated with new debt will typically increase in number and become much more stringent, much more restrictive. The lender needs more assurances, more rules to protect their investment. These could include things like limits on the company taking on any additional debt, restrictions on paying dividends or buying back stock, requirements to maintain certain financial ratios, like a minimum level of current assets relative to current liabilities, or a maximum debt-to-equity ratio, or even limits on selling major assets. The higher the perceived risk based on capital structure, the tighter the covenants.
Makes sense. Lenders want to protect themselves when risk is higher. Okay, shifting focus slightly. Ultimately, what do investors, both equity holders and debt holders, really want to see from the company they've put their money into? It usually boils down to two key things, right? Sustainable growth and consistent profitability. These two factors, often the main headline goals for any business, seem like they would be profoundly affected by a company's capital structure choices. It's truly where the rubber meets the road for financial strategy.
Absolutely, you've hit the nail on the head. Growth and profitability provide that crucial assurance to all capital providers that the company will be able to meet its obligations, like interest and principal payments to debt holders, and hopefully deliver a positive return on investment through dividends and capital appreciation for equity holders. And yes, both of these outcomes are significantly impacted by how a company chooses to finance itself. Those capital structure decisions are far from just academic exercises. They have real-world consequences for performance.
Okay, let's talk specifically about growth rate. We know that when a company earns profits, net income, it typically faces a fundamental decision. How much should be paid out to shareholders as dividends, and how much should be retained and reinvested back into the business? That allocation seems like it would be a primary driver of future growth.
It's absolutely foundational to understanding a company's potential for organic growth. That is, growth generated internally without relying solely on external financing. That allocation decision is key. The sustainable growth rate, often denoted in finance texts as G, can actually be estimated using a formula that links profitability and retention. A common formula is growth rate G, return on assets at kind of retention ratio 1, return on assets x retention ratio.
Okay, ROA times retention divided by 1 minus that same product. What exactly is the retention ratio here?
The retention ratio is simply the proportion or percentage of a company's net income that is not paid out as dividends. It's the fraction of profits that the company keeps and reinvests back into itself, presumably to fund future expansion, new projects, or acquisitions. If a company pays out 30% of its earnings as dividends, its retention ratio is 70% or 0.70.
Got it. Let's calculate an example then. If a company consistently generates a return on assets, ROA, of 7.5%, and it follows a policy of paying out 40% of all its earnings as dividends, what would its expected sustainable growth rate be based on this formula?
Okay, so if the company pays out 40% of its earnings as dividends, that means it retains the remaining 60%. So its retention ratio is 1.60, its return on assets ROA is 7.5% or 0.075. Now we plug those into the formula. G ROA retention, 1 ROA retention. G also 0.075, 0.60, right? 1.075.60. First, calculate the product in the numerator and denominator. 0.075, 0.60, 0.045. So I want a 0.045.
Right, got
0.045, 0.045, 0.955. Calculating that division, 0.045, 0.955 is approximately 0.0471 or 4.71%. This tells us that given its current profitability, ROA, and its dividend payout retention policy, this company can sustainably grow its earnings and assets at a rate of about 4.7% per year purely through internally generated funds without needing to raise additional external capital.
That's a useful metric. So how does the company's capital structure itself actually influence the sustainable growth rate? It feels like the debt equity mix should have a direct link here too.
It absolutely does play a significant role, influencing both parts of that growth calculation, profitability and retention, although sometimes indirectly. First, the retention ratio itself, while primarily driven by dividend policy, can be influenced by the level of equity within the company's capital structure and the expectations of those equity holders. If a company has a very large base of equity holders who strongly prefer high current dividends, that might pressure the company towards a lower retention ratio, which in turn would lower its sustainable growth rate, all else equal. Second, and perhaps more directly, measures of profitability like return on equity, ROE, which is closely related to ROA and growth, are significantly affected by a company's capital structure.
How so?
Well, net income, which is the numerator in ROE, net income equity, is directly reduced by the interest expense associated with the company's debt. The more debt a company uses, higher financial leverage, the higher its interest expense will be, which eats into net income. The amount of equity relative to assets, which is influenced by the debt level, also impacts the denominator of ROE, the relationship between ROE and ROA. A higher ROE, driven by efficient use of assets and potentially amplified by leverage, up to a point, generally has a positive effect on the potential for overall company growth. So managing that debt-equity mix to optimize profitability metrics like ROE is critical to fueling sustainable growth.
Right. The interplay is complex. Beyond just growth, overall profitability is paramount. What are the key measures of profitability that investors and managers look at, and how does capital structure impact them?
You're right, profitability is key. There's several standard ratios used to measure it, and generally a higher ratio is always considered desirable, whether you're tracking a single company's performance over time or comparing it to its competitors or industry benchmarks. Some common ones include return on sales, ROS, often calculated as income before interest income, interest expense, and taxes, sometimes just EBIT, divided by net sales. It measures operating efficiency. Return on investment, ROI, which is a broader term, but often calculated as net income divided by average invested capital, which might include both debt and equity. Return on assets, ROA, which we just used, typically net income divided by average total assets. It measures how effectively the company uses all its assets to generate profit. And finally, return on equity, ROE, which is net income divided by average total equity. This measures the return generated specifically for the common shareholders.
And how do those capital structure decisions, the mix of debt and equity, directly filter down to affect these profitability measures? It sounds like there's a strong connection, especially to the company's bottom line, its net income.
There is indeed a very strong and direct connection. Think about it. These ratios all measure profitability after the effects of the company's capital structure decisions have already been accounted for, particularly on the income statement. Let's take net income again, which is the literal bottom line profit figure and a key input for ROI, ROA, and ROE. Net income is calculated after deducting interest expense. So the higher an entity's level of debt in its capital structure, the greater the amount of interest expense it will incur. This directly reduces its earnings before tax and consequently its net income.
More debt means less net income, all else equal.
All else equal, yes. And this lower net income then ripples through all those key profitability ratios that use net income in their calculation, ROI, ROA, and ROE, potentially pushing them lower than they might have been with less debt. Furthermore, while dividend payments don't directly reduce net income, their distribution of net income, the policy around dividends affects these ratios indirectly. For example, paying high dividends reduces the amount of retained earnings, which shrinks the equity base over time, affecting ROE's denominator, and also reduces assets. Cash goes out the door. So yes, capital structure choices directly influence how much profit is ultimately available for shareholders and how efficiently the company appears to be utilizing its assets and equity base.
Okay, this leads us perfectly into our final major section, leverage. This seems like such a critical factor weaving through everything we've discussed: capital structure design, risk, return, profitability. It fundamentally affects profit variability and, therefore, the risk and return demanded by both creditors and owners. You mentioned financial managers have to consider two distinct types of leverage: operating and financial. Let's break those down.
That's right. They are related concepts, but focus on different types of fixed costs. Let's start with operating leverage. 7.1.1 definition. Operating leverage refers to the degree to which a company utilizes fixed operating costs, as opposed to variable operating costs in its production process or service delivery. Think about the nature of the business. A capital-intensive company, like an airline with huge investments in planes and facilities, or an automobile manufacturer with massive factories and robotic assembly lines, will generally have high operating leverage. A large portion of their costs, depreciation on equipment, rent, property taxes, some salaries, are fixed. They don't change much whether they sell one more seat or one less car. Contrast that with a labor-intensive business, perhaps like a consulting firm or a software development shop where the primary cost is salaries. Their costs might be more variable, potentially scaling up or down more easily with revenue. They would typically have lower operating leverage.
Okay, so high operating leverage means lots of fixed costs in your operations. What are the strategic implications of having high operating leverage? It sounds like it could be a powerful tool for boosting profits, but maybe also quite risky.
It absolutely is a double-edged sword. That's a perfect way to put it. 7.1.2 implications. A company with high operating leverage must generate sufficient sales revenue just to cover those high fixed operating costs. That's its break-even point. Now, when sales revenue is high, high operating leverage can be extremely beneficial. Why? Because once those substantial fixed costs are covered, a very large percentage of each additional dollar of sales drops straight down to operating income, or EBIT, earnings before interest and taxes. The variable cost per unit might be relatively small.
So profits can soar quickly once you get past break-even.
Exactly. This also means a company with high operating leverage will generally exhibit greater risk, but also offer greater possible returns. The risk comes from higher profit variability. If sales decline, even moderately, that company might struggle significantly to cover its large fixed costs, potentially leading to steep operating losses very quickly. Remember, those fixed costs don't go away when sales dip.
That's the downside risk. What about the upside again?
Beyond the break-even point, a company with higher fixed costs, and thus lower variable costs per unit, often implying a higher contribution margin, which is sales minus variable costs, will actually retain a higher percentage of any additional revenues as operating income, EBIT. Once the fixed costs are covered, more of each sales dollar flows to profit.
Can you give us an example to illustrate that magnification effect?
Sure. Our source material gives a great example. Consider Pat Jones's company. Jones observed that his company experienced a remarkable 21% increase in its EBIT as a result of only a 5% increase in sales. That's a big jump in profit from a modest sales bump. His competitor, however, operating in the same industry, only saw a 10% increase in its EBIT from the very same 5% increase in sales.
So Jones's company profits are much more sensitive to sales changes.
Precisely. This indicates that Jones's company has significantly higher operating leverage than its competitor. It implies that fixed costs make up a higher proportion of Jones's total operating costs. As a result, Jones's company likely needs to generate more revenue just to reach its break-even point compared to the competitor. But, and this is key, once those higher fixed costs are met, any additional revenue will translate into significantly higher operating profitability for Jones's company compared to the competitor. That 5% sales increase generated much more incremental profit for Jones. It magnifies the impact of sales changes on operating income.
Okay, that clarifies operating leverage. It's about fixed operating costs. Now let's turn to financial leverage. How is that different, and what are its key pros and cons?
7.2.1 definition. Financial leverage is different because it focuses on the financing side, not the operating side. It's defined as the degree to which a company uses debt, which incurs fixed financial costs, namely interest, rather than equity to finance its assets. When a company issues debt, it generally takes on an obligation to pay fixed interest costs, regardless of its operating performance or profitability level. Equity issuances, by contrast, do not result in an increase in mandatory fixed costs because, as we've discussed, dividend payments on common and even preferred stock are typically discretionary, not legally required in the same way interest is.
So, financial leverage is about fixed financing costs, specifically interest on debt. What are the implications, the pros and cons of using a lot of financial leverage?
7.2.2 implications. Similar to operating leverage, a company using significant financial leverage, lots of debt, must produce sufficient operating income, EBIT, just to cover its fixed interest costs. That's the first hurdle. However, once those fixed interest costs are covered, any additional EBIT generated flows directly down towards net income and, crucially for shareholders, towards earnings per share, EPS. This creates a similar magnification effect to operating leverage, but this time between EBIT and EPS. A relatively small percentage change in EBIT, whether it's an increase or a decrease, can result in a much larger percentage change in the company's net income and EPS.
So, leverage amplifies results, good or bad, on the bottom line.
Exactly. Another significant benefit, or pro, of financial leverage is the one we keep coming back to. Interest costs are tax deductible, whereas dividend payments are not. This tax shield provides a direct financial advantage to using debt over equity.
Okay, magnification of profits and tax savings sound good. What's the big con or downside?
The major con, and it's a significant one, is the increased risk of bankruptcy or financial distress. Companies that are highly leveraged, have a lot of debt relative to their equity or earnings, are inherently at a greater risk of defaulting on their obligations if their operating income falters or if they face unexpected financial shocks. They simply have less cushion. If they do run into trouble making their debt payments, they may find it extremely difficult or even impossible to find new lenders willing to provide additional funds. High leverage can significantly increase the probability of financial ruin if things go wrong.
Can you illustrate that magnification effect on EPS?
Sure. Imagine a firm that has a significant amount of debt in its capital structure. Let's say this firm experiences a 42% increase in its EPS as a result of only a 21% increase in its EBIT. This tells us two things. First, the firm is generating more than enough operating income, EBIT, to comfortably cover its fixed interest costs. Second, the impact of that EBIT increase on EPS, a doubling effect here, 42% go once, 21%, has been significantly magnified by the company's use of financial leverage. Now contrast that with what might have happened if that same firm had achieved that 21% EBIT increase, but had financed itself primarily with equity instead of debt. In that scenario, its EPS most likely would have increased by less than 21%, or potentially even decreased if the equity financing involved issuing a large number of new shares, because the earnings would be spread over a larger number of shares outstanding. EPS dilution. So the conclusion is clear. Higher financial leverage means greater potential profitability, magnified returns on the upside, but it also inescapably means greater risk, magnified losses on the downside, and higher bankruptcy probability. It's truly a double-edged sword that requires careful management.
That trade-off is stark. Given that financial leverage amplifies risk, but also offers potential benefits like tax shields, how does the presence of debt impact the overall value of a firm? What's the theoretical value of a levered firm compared to an identical firm that has no debt?
7.3.1 definition. This gets into some classic finance theory. First, let's define terms. A levered firm is simply a company that has debt in its capital structure. An unlevered firm is one that relies solely on equity for its financing. It has no debt. According to a widely cited theory, often associated with Modigliani and Miller, but incorporating taxes, the value of a levered firm can be calculated using a specific formula, assuming the debt is permanent or long-term. Formula. Value of a levered firm. Value of an unlevered firm plus present value of the interest tax savings. The key component here is the present value of the interest tax savings. If we assume the debt is permanent, this present value simplifies nicely. It's calculated as corporate tax rate eggs annual interest expense, interest rate on debt, or even simpler under permanent debt assumption, tax rate amount of debt.
Wait, the present value of all future tax savings just equals the tax rate times the amount of debt. That seems surprisingly simple.
Under the specific assumption of permanent debt, yes, the math simplifies quite elegantly. The annual tax saving is tax rate, interest rate, debt amount. To find the present value of a perpetual stream of these savings, you divide by the discount rate, which in this context is the interest rate on debt. The interest rates cancel out, leaving just tax rate amount of debt.
Okay, that's neat. So the core insight here is that having debt adds value to a firm because of the tax shield.
7.3.2 implications. Exactly. The core benefit that drives this theoretical difference in value is precisely the tax deductibility of the interest payments made on the debt. Think of it as the government effectively giving the company a rebate on a portion of its interest expense every year forever under the permanent debt assumption. These cumulative annual tax savings, when discounted back to their value in today's dollars, represent the additional value that a firm gains simply by choosing to include debt in its capital structure, compared to an identical firm that operates solely with equity. It's a powerful theoretical argument for why firms might prefer to use at least some debt financing.
Let's run a quick calculation to make this tangible. Imagine an unlevered firm, one with only equity, has an estimated total market value of $130 million. Now, suppose this company decides to change its capital structure by issuing $25 million in long-term debt at a 5.75% interest rate. The corporate tax rate is 30%. According to the formula, what's the new estimated value of this now levered firm?
All right, let's apply the formula. Value of unlevered firm plus PD of interest tax savings. First, we need the present value, PV of the interest tax savings, using the simplified formula for permanent debt. PV equals tax rate amount of debt, PV equals 0.3025 million dollars, $7.5 million. So the tax shield provided by this $25 billion in debt is theoretically worth $7.5 million in present value terms. Now we add this to the value of the unlevered firm. Value of levered firm equals $130 million plus $7.5 million from $137.5 million.
So just by issuing that debt and taking advantage of the tax code, the firm's theoretical value increased by $7.5 million, from $130M to $137.5 million.
According to this specific model, yes. That debt, purely due to the tax deductibility of its interest, effectively added $7.5 million to the company's total value. It highlights just how significant the tax implications of capital structure can be.
Wow, what a journey we've been on. We've gone from the foundational components of capital structure, the basic building blocks of debt and equity, all the way through to the intricate nuances of calculating the weighted average cost of capital. We explored the quest for that elusive optimal structure that minimizes WACC and then delved deep into the powerful and sometimes dangerous forces of operating and financial leverage and their impact on growth, profitability, and ultimately firm value. It's become incredibly clear throughout this discussion that these aren't just abstract financial concepts found in textbooks. They represent the absolutely critical strategic decisions that truly shape a company's trajectory, its risk profile, and its ultimate success or failure.
Absolutely. And reflecting on all this, it raises an important question, maybe a final provocative thought for you, the listener, to ponder as you digest all this information. Given this complex interplay we've discussed between risk, return, growth, taxes, flexibility, control, how might a company's specific industry or its stage of growth influence what its optimal capital structure actually looks like in practice? Think about it. What kind of financing mix might an aggressive high-growth startup in a rapidly changing technology sector favor compared to, say, a very mature, stable utility company operating in a highly regulated environment with predictable cash flows? And more importantly, why would their financing choices likely differ so significantly based on their unique circumstances and strategic goals? Something to definitely mull over.
That's a fantastic question to leave us with. What a deep dive today. Thank you so much for guiding us through this complex but crucial area of corporate finance. And thank you, our listeners, for joining us on this exploration into the fascinating, intricate world behind how companies are funded. We hope you'll keep digging, keep questioning, and continue to explore the dynamics that drive businesses forward. Until next time, on The Deep Dive, keep diving deep.